If you're panicking about a sale next month, slow down because we've got plenty of time to see how this shakes out. If the CGT discount is reduced or removed, it doesn't just change tax, it changes behavior. So when selling becomes more expensive, people don't sell. They refinance instead of selling. So behavior definitely matters, and tax policy doesn't exist in a vacuum. So they could very well just end up with a break-even situation at best.
Welcome to Perth Property Insider, where you will learn how to grow your wealth and improve your life using Perth property. Our show is brought to you by Investors Edge Real Estate, the highly rated and award-winning property management, sales and buyers agency servicing the whole of Perth. Now, here's your host, Jared Mann.
G'day and welcome to Perth Property Insider. I'm your host, Jared Mann. There's been a lot of noise over the last few days around proposed changes to capital gains tax, specifically the CGT discount that investors get when they sell a property they've held for more than 12 months. Headlines are flying, the WhatsApp groups are lighting up, and I've already had messages asking, should I sell now? Is property about to be smashed? Is this the end of investing as we know it? So today, let's slow this right down. And in this episode, I want to cover 5 things. What the CGT discount is now, and what's actually been proposed. Number 2, what needs to happen for these changes to actually become law. 3, how this could change investor behavior and strategy. 4, what this might do to the property market, prices, supply, and rents. And finally, whether this really raises government revenue or just reshuffles the deck. This is not advice, it's education, but by the end of this episode, you should be far clearer and hopefully a lot calmer. Let's start with the basics, shall we? Right now, if you're an individual investor and you sell a property you've held for more than 12 months, you receive a 50% capital gains tax discount or CGT discount. That doesn't mean you pay 50% tax. It means only half of your capital gain is added to your taxable income. So if you make a $400,000 gain, as many investors may have done over the last few years in Perth, only $200,000 would then be taxed at your marginal rate. So the proposal being discussed at the moment is to reduce that discount from 50% to 25%, and in some versions to remove it entirely for investment properties. So that would mean instead of taxing half your gain, you're taxing 75% or potentially 100% of your gain. Importantly, to note, this is not law, nothing has passed, and there's no start date has been announced. What we have right now is a Senate inquiry into the CGT discount, growing political pressure around housing affordability and just looking anywhere for a scapegoat or a solution. It seems to be more scapegoats than solutions, and a renewed public discussion about whether property investors are undertaxed. This idea is not new. It's been parked, unparked, and dusted off again, and now it's back. So this is where context really matters. Let's take a look at what's been tried before and why it's failed. Labor actually took a very similar policy to the 2016 and 2019 elections, reducing the CGT discount from 50% to 25%. And they lost both those elections. After 2019, the policy was quietly shelved because it was seen as a politically toxic, especially in outer suburbs and with so-called mum and dad investors. Since then, the discount has stayed untouched. So what's different now? Housing affordability is even worse. So we've got more screaming, people upset about not being able to get into the market, and rightly so. Rents are under serious pressure as well, and there's no sort of relief for that in sight. And the federal budget is stretched, and they're trying to find ways to make up tax revenue to help that. That's why this conversation's back. But history tells us something important. Proposing a CGT change is easy. Passing it is very hard. So what needs to happen for this to become law? Let's take a look at this. For these changes to actually happen, a few hurdles need to be cleared. First, the government would need to formally announce a policy, most likely in a federal budget. Then legislation has to pass. So the House of Representatives need to get it through first. That's likely doable because Labor has the clear majority there. And then in the Senate, that's where the problem might be for Labor. because it doesn't control the Senate outright. To pass this, they would almost certainly need the support from the Greens, who actually want the discount removed entirely. And that makes this a political balancing act. Push too hard and you spook investors, push too soft and you upset the left flank of the Greens. And historically, when governments make big tax changes like this, they give long lead times, or they grandfather existing properties to be exempt, or they phase changes in gradually. So a sudden overnight switch is extremely unlikely, or they're going to upset a lot of people and potentially then affect votes come next election. So if you're panicking about a sale next month, slow down, because we've got plenty of time to see how this shakes out, and it's unlikely to be an overnight thing, even if it's implemented. So how could this change investor strategy? This is where things get interesting and I like to ponder. So if the CGT discount is reduced or removed, it doesn't just change tax, it changes behaviour. The first big impact, investors will likely hold longer. So when selling becomes more expensive, people don't sell. They hold through cycles. They refinance instead of selling. They defer sales until retirement when income is lower. Ironically, removing the capital gains tax discount may actually reduce property turnover. And the second impact is that there would be less cycling in and out of markets. I've been a big proponent of holding properties for the longer term and also done the maths on just how high a return you need to get, which is nearly 2.5 times the return, to factor in the existing capital gains tax you'd need to pay plus the entry and exit costs. So you can only imagine reworking those numbers. And if the tax is higher or with no discount at all, then the return that you might need, I haven't redone the numbers yet, but it would really make the case even stronger for holding a property long term and not cycling in and out.
Just real quick before we continue on with the episode, are you getting my email updates yet? If you're not, you're missing out on our suburb intelligence reports, which we tailor and prepare for your individual suburbs of interest, showing advanced stats and insights. Must get onto those. And I also send out exclusive invitations to our events, including webinars, sundowners, and workshops. So if you're not getting those, head on over to investorsedge.com.au/join and make sure you're receiving my email updates.
So if there's no longer a meaningful tax benefit after 12 months, flipping and short-term speculation become far less attractive. And that pushes investors towards higher quality assets, better locations, and properties they're happy to hold for decades. So the third impact, exit timing becomes everything. So investors will be far more strategic about which year they sell, their marginal tax rate at the time of their sale, and whether they wait until retirement when their other taxable income's lower, their effective overall tax rate will be lower, and that timing would potentially be far more important to the savings that you'd make. So, and yes, if a change is announced with a future start date, there could absolutely be a rush of sales beforehand of investors trying to get out of properties that they aren't intending to hold longer term. Imagine all the investors that are in Darwin, all the speculators. It could really affect some areas far greater than others where speculation has been rife. So investors will then be looking to lock in the 50% discount while they still can. After that, we're likely to have a long drought of listings from investors because we would have brought forward sales earlier than they may have happened. So that could then make a sales drought for a while. And let's take a look at how this could affect the property market, because we're going to have some other flow-on effects potentially. So because this is where a lot of assumptions get things wrong, I wanted to spend some time on it. The argument for reducing the capital gains discount is that it'll reduce investor demand. It'll therefore, if investor demand slows on the buying side, it would potentially lower prices and improve affordability. That's the argument of the Greens and Labor's thinking around these things. But in reality, I think the impact on prices is likely to be very small, if at all marginal, because most economic modelling suggests that changes like this might shave a few percent off prices over the longer term and it certainly won't create a crash or any large dip. But here's the bigger issue. If investors sell less, buy less, and build less, what happens to the supply? We'd likely have fewer rentals, tighter vacancy rates, higher rents, and we're already seeing this today. So while this policy might sound good politically, there's a very real risk that it's going to reduce rental supply, push rents higher, and hurt the exact people that it's meant to help. Housing affordability is a supply problem, not just a tax problem. And it does seem like the government is doing lots of things except tackling the real problem. We've increased funding and financing for first home buyers. That's led to our market absolutely going crazy. It added to demand. It didn't add to supply. And now they're looking at doing this where they'll potentially reduce supply, take away a little bit of demand, but it's going to be a very negligible overall impact from what I can read of the studies. So should you sell now? And what are the odds this hits next year? And I'm talking next financial year. So let's answer the big personal question. If you're thinking of selling next financial year, should you rush? Right now, there is no confirmed start date, there is no legislation, and there's no guarantee that this even passes. So I wouldn't be following the speculation and going and putting your property on the market. If changes happen, history suggests there'll be warning and there'll be transition rules and there may be grandfathering. When we say grandfathering, it might not apply to existing property owners at all. So panic selling purely for tax reasons is really a good strategy, but staying informed and ready to act, that's smart. And that's why I'm bringing you this episode so quickly, because there's a lot of noise out there at the moment. And this is where good advice and timing matter. And by all means, stay tuned in and also speak with your other advisors, such as your accountant, who is the real expert when it comes to tax and how best to plan towards it. So will this actually raise more tax revenue for the government, which is probably one of the core reasons that they're trying to do it? Finally, it's the big question, isn't it? And on paper, reducing the CGT discount does raise billions. In reality, if half the investors don't sell compared to normal, the government may collect the same or even less capital gains tax. So higher tax per sale, fewer sales overall, fewer potential purchases from investors, reducing state government stamp duty revenue. So behavior definitely matters, and tax policy doesn't exist in a vacuum. So they could very well just end up with a break-even situation at best. So where does this leave us? The proposal doesn't mean the end of property investing. If anything, it reinforces timeless principles that I follow. You want to invest in quality assets. You want to have long-term thinking. You want to have strategic exits, and you want to understand the rules before you react. And don't go making any wholesale changes off of stuff you see in the news, because we've been in this boat before in the past. I just think back to 2016, 2019 for the CGT proposals, and I think back to other state government proposals that have scared everyone initially, but then not gone ahead. So if you're investing for decades, not headlines, this is just another cycle to navigate. And if you found this episode useful, share it with someone who's currently stressing about CGT. And as always, get advice, stay informed, and don't let policy noise knock you off a solid long-term plan. I hope you've enjoyed this episode. And if you have, post a quick comment or review. I really appreciate it. Catch you next week.
Just a reminder, the information discussed in this podcast is general in nature. As we don't know your specific situation, you should always seek professional advice before taking any action. For free market reports on your suburbs of interest and other helpful resources to grow your wealth, make sure you join my property investor update at investorsedge.com.au/join. And finally, make sure you're a member of our Perth Property Investment Facebook group to be part of the conversation with other like-minded investors, get help to your questions, and get a feel for what's going on out there in the market. I'll see you in the group.